In this chapter, we're going to cover consolidated tax returns. For a corporation to be able to file a consolidated tax return, they have to be an affiliated group. And to be an affiliated group, they have to meet 1. The parent corporation directly owns stock having at least 80% of the total voting power of all classes of stock entitled to vote, and at least 80% of the total value of all outstanding stock in at least one includable corporation. So this is a little bit different than our related corporations, and we'll talk about that in just a second. And for each other corporation, so not the parent, for each other corporation eligible to be included in the affiliated group, stock having at least 80% of the total voting power of all classes of stock entitled to vote, and at least 80% of the total value of all outstanding stock must be owned directly by the parent and the other group members. Includable corporations are all corporations except corporations that are exempt from taxation under Section 501, life insurance companies subject to tax under Section 801, foreign corporations, regulated investment companies, real estate investment trust, and S-corps. So like I briefly mentioned before, controlled groups and affiliated groups are different. A parent sub-controlled group stock ownership rule is at least 80% of voting power or value. And remember, for the affiliated group, it was both voting power and value. The affiliated group stock ownership rule is at least 80% of voting power and value, like I just said. Stock attribution rules apply to controlled groups, but not affiliated groups. And remember, stock attribution rules treat certain individuals as owning stock they don't actually own by either family relationships or entity relationships. And we apply those when we talk about control groups, but not affiliated groups. Types of corporations excluded from controlled groups is different from those excluded from affiliated groups. And the control group test is applied on December 31, but the affiliated group test must apply every day of the year to be able to file a combined tax return, a consolidated tax return. When a consolidated tax return election is made, the affiliated group elects to file it by filing a corporate return including the tax items of all members of the group no later than the due date for the common parent's tax return. So if they all have different tax return due dates, they file it by the due date for the common parent's tax return. And then the consolidated tax return filing continues until it terminates, and it can only terminate with IRS permission. So an affiliated group remains in existence for a tax year if the common parent remains as the common parent and at least one subsidiary that was affiliated with it at the end of the prior year remains affiliated at the beginning of the year. The parent need not own the same subsidiary throughout the entire tax year, nor own any subsidiary throughout the tax year, and the IRS may allow termination for good cause. So this seems like it would be simple. It seems like we would just compute each corporation's net income and add them up, but that's not exactly how it works. When we calculate consolidated taxable income, the accounting period must be the parent's tax year. The subsidiary must retain the parent's tax year upon leaving the affiliated group. The accounting methods for the consolidated return are determined as if each member were filing individual tax returns. So the methods can still differ between members. So one can be on the accrual basis of accounting and one could be on the cash basis of accounting. That's still permitted. The consolidated tax return is going to include the parent's income for the entire tax year, except for any portion of the year that it was a member of another affiliated group that filed a consolidated tax return. A subsidiary corporation's income is included in the consolidated tax return only for the portion of the affiliated group's tax year for which it was a member. When a member of an affiliated group is a member for only part of the year, the member's income for the remainder of the year is included in a separate tax return, or the consolidated tax return of another affiliated group. And that short period return is a full tax year for purposes of net operating loss and other carryovers. Okay, so these are our step-by-step instructions. We're going to talk about these a little bit more in later slides. But to get consolidated taxable income for an affiliated group, step 1 is to compute each group member's taxable income or loss based on the member's own accounting methods, as if it were filing its own separate tax return. So just like we've done before, we calculate each member's taxable income. Step 2, we're going to adjust each group member's taxable income as follows. So first, income, gains, and losses on intercompany transactions occurring in the current year may be deferred until a later year. 2, income, gains, and losses on intercompany transactions occurring in prior years may be taken into account in the current year. 3, dividends received by one group member from another group member are excluded from the recipient's gross income. So in step 2, you see we're really concerned with things that happen between affiliated group members. And this is fairly common because usually, or not usually, but I would say often, corporations that are affiliated are so affiliated because they conduct business together. So we might purchase the corporation that supplies our inventory, and we might also purchase the corporation that runs our distribution channel. So we buy and sell things between these corporations. And when we prepare a return on a consolidated basis, we want to eliminate those intercompany transactions. We want to treat it as if it was one entity the whole time. So you'd never record profit if you sold something to yourself. Step 3 is to remove certain items from each member's taxable income because they must be computed on a consolidated basis. These include 1231 gains and losses, capital gains and losses, charitable contributions deduction, dividends received deduction, net operating loss deduction. And if you think about all of these things, it makes sense to pull them out here because these things all have limits, right? The charitable contribution deduction, for example, has that 10% limit. The dividends received deduction has a limit. The net operating loss has a limit. And so we are going to apply that limit on a consolidated basis rather than an individual basis on individual tax returns. Step 4, combine the members' separate taxable income and losses. This amount is called the combined taxable income. After we've removed everything that happens between the companies, we've removed intercompany transactions, and we have removed things that need to be calculated on a consolidated basis, all that's left is separate taxable income and loss that can be all added together now. And when we do that, it's called our combined taxable income. After we get that, we go on to step 5, and we adjust the group's combined taxable income for the following items computed on a consolidated basis. And everything here is everything that we removed from step 3. So now we're essentially adding it back in step 5. The 1231 gains and losses, the net capital gains and losses, the charitable contributions, the dividends received deduction, and the net operating loss. After we do all of that, we get our consolidated taxable income or loss.